Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
And good morning. And I'm trying to sound like Shane Griffin, but I can't. This is Rick Durkee. Good morning, everyone. And you're with 94.3 WSC FM and Retire Right. And my guest this morning is going to be Doug Schneider. Shane is going to be with us on all other weeks except for when I bring in a guest. And what we're doing is continuing some of our successful formatting from shows of past when we used to have Money Matters and used to bring on a guest that would be appropriate for the times. And right now it's time to think about taxes. Doug Schneider. Good morning, Doug. How are you?
Good morning, Rick.
Glad to have you here on Retire Right. And what I'd like to discuss with you today for our listener out there that needs to do some preparation for 2015 personal tax returns, Doug, is that first of all, I'd like to give a little background for yourself. Doug has been helping individuals and businesses here in South Carolina develop financial leadership cultures over the last 25 years. Doug certainly is an educator, and that's why we asked him to be on the show this morning. Doug understands that preparing personal tax returns can be confusing, frustrating, costly, but this constantly changing tax law environment can certainly perplex even the savviest of taxpayers. So for those of you listening this morning that want to find some money-saving deductions, credits, and some things that can easily be overlooked and slip through the cracks, Doug will be here to help us today with the changes in the tax code and help understand those changes and how they affect individuals and small businesses. One other point is that the South Carolina Association of CPAs has recognized Doug as one of the top 100 influential CPAs in South Carolina in the last century. And again, that's why we have him on our show. Doug, hey, this is great. Let's talk about this time of year. We're beginning to see in the mailbox things like our W-2s, our 1099s, investment statements. So it's time to prepare for our 2015 tax returns. What are some of the tips that you'd like to share about completing personal tax returns this morning?
Well, thanks, Rick. During our time today, I'd like to focus on 5 areas. First, I'd like to talk about determining if there are any 2015 tax deductions still available, even though we're already over a month into 2016. Second, how the Affordable Care Act impacts completing your personal tax returns. Third, determine what to do with the tax return results, whether that's if you owe taxes or possibly refunds. Fourth, I'd like to talk a little bit about using your 2015 tax return information to start planning for your 2016 taxes. And then fifth, I'd like to offer ways to use the IRS website.
Okay, sounds like some good information that we'll be covering this morning. Are there any payments that can be made in 2016 that are still deductible on the 2015 tax return, Doug? I know everybody's wanting to know that.
There's very few, but there's certainly one that people can do, and it's there are a few areas individuals need to review to determine if a stuck deduction is still available. The primary area is one that really makes sense for not just the tax return, but even for your future, and that's to make an IRA contribution in 2016 or 2015. 401k contributions that typically need to be made by the end of the calendar year, but IRAs, actually you have until April 15th to make the contribution for the previous year. So for a lot of my clients, they've waited to 2016 because we want to see what their tax return looks like. Potentially because depending on if it makes sense for us to do a traditional IRA or possibly for a tax break or possibly do a Roth IRA and pay the taxes this year and then not pay taxes ever again on those Roth IRA contributions. The limitations are that the traditional IRA, you can pay up to $5,500 for 2015 and 2016. And then there's catch-up provisions that if you're older than 50, you can add another $1,000 to that for the IRA. So that's certainly beneficial whether you use the traditional or Roth IRA. It's certainly something that you'd want to consider, not just doing the $5,500 if you're over 50, doing another $1,000. But, Rick, I'm sure you have clients asking you all the time about retirement plans, and certainly when you get to this position about making a contribution, the difference between really the traditional IRA and the Roth.
Mm-hmm. Well, Doug, what we see is mainly with people that are either very close to or already in retirement, we see the fact that maybe they can still make a Roth contribution. Maybe they still do have earned income. Maybe they're working part-time or something like that. But the most beneficial opportunity that we see for our clients and prospective clients is the fact that they can convert their current IRA into a Roth. Now, when that does happen, of course, taxes need to be paid. So there's some tax forward planning that needs to be done with a professional like yourself to make sure that these are sound decisions and they are in the client's best interest as to how to phase out of their IRA and pay taxes and then go into their Roth. But mainly the biggest difference between the traditional IRA and the Roth IRA, of course, if you're funding with new dollars, is that the IRA is deductible and the Roth is not. The Roth does give the advantage of the tax-free growth, but you got to remember that you can't take it out before 59.5 without a 10% penalty. And secondly, you have to leave that Roth money in there for 5 years before you touch it. So, but you really want to do that anyway with a Roth. You want it to compound, grow, and certainly take advantage of that tax-free growth.
And Rick, I'm seeing even a lot of my younger clients now choosing, because they're still at the lower tax rates, they're choosing to select a Roth because they're not getting a huge tax advantage by putting that money aside. But then there will be a great advantage because that money has grown over those years. So that's a great advantage for those ones that are near retirement age, but also those ones that are just starting to put into the retirement plan.
Good point. And we do have those listeners on our show, too, that are retirement-minded, but they're just younger, and they need some good ideas. Thanks, Doug.
Absolutely. And just as we stay in the retirement arena, we want to make sure that if you've waited to 2016 to contribute to your IRA, you just want to make sure that you specify that to your financial institution where you're making it, because sometimes they automatically apply it to the year you're making it. So you want to make sure they put it in the right year.
Right.
One other area related to retirement that may affect some taxpayers is a saver's credit. The saver's credit can be claimed up to $2,000 individual and $4,000 for couples. For that contribution made, you get additional credit for it. The difficulty is it is really for those people not making a significant amount of annual income. So it's a winning situation because you can save for your retirement and then get an additional tax deduction, but the limitations start where if you make over $36,000 on a joint return, those phase out. But some situations the tax saver's credit do apply. Moving on, the other deductions, not that you can make these deductions in 2016, but some people miss the standard deduction, the itemized deduction versus the standard deduction. You need to look at if you actually pay state tax withholdings, mortgage payments, real estate taxes, charitable contributions. All of these expenses add up. And if those expenses add up, if you're a single taxpayer over $6,300, you might want to choose to itemize on your tax return. In other words, getting more deduction on your tax return than just taking the standard deduction.
Doug, before you go into those standard deductions, you mentioned charitable contributions. I did hear from our certified financial planner in the office that by the end of last year that Congress did approve indefinitely or without having to reapprove every year,
right,
that you can make a direct deduction or direct contribution from your IRA to a charitable contribution or a charitable organization, and it will save you some dollars in taxes, won't it?
Correct.
Yeah.
Yes, those extenders, as we talked about, you hear the extender terminology toward the end of the year, waiting on Congress to approve things either for the temporary deductions or temporarily every year, or sometimes they make them permanent. And you're right, they've made some of them permanent, which that is one of them.
Yep, can save you some tax dollars from slipping through the cracks. If you'd like some information on that, certainly call us this morning, 735-5065, and we'll get you some information out on that.
Well, Rick, relating to that extender provision that you were talking about on the charitable contributions, there was also the child tax credit that was in that extender law that Obviously, it costs hundreds of thousands of dollars to raise children these days. I have 15-year-old twins, so I'm right there with it. But the law was going to change so that you wouldn't get a tax credit or non-refundable credit for $1,000 if you qualify for each child. That was going to go away again, but because of the law, they made it permanent. So the changes let the benefit of the additional credit scheduled to be going forward in a permanent fashion. But again, some of the limitations, there's 7 tests you have to meet to get this child tax credit. I won't cover all 7, but one of them is that if you're a joint filer, it phases out after you make $110,000 worth of taxable income. So again, that child tax credit is there and available, limited to depending on what your income is on your tax return.
Okay, Doug, we're covering a lot of topics today. I think people are probably writing this stuff down as fast as they can, and then we're going on to the next subject. But let me remind everyone that transcripts are available of this show in writing. If you would like a transcript, certainly email us. You can email me at rick@cfpgroup.biz, or you can call us this morning at 735-5065. And if you need someone to help you do your tax planning for 2015 and what time is left for what things we're covering today, or if you need somebody to work on you in a tax forward respect for 2016, call us this morning. We'll connect you with Doug Schneider. Doug, over the past few years, there have been a lot of media coverage and discussion about the Affordable Care Act, ACA as we know it. How does the ACA impact a person's individual tax return?
You're right, Rick. Since about 2010, we've been talking about it and planning for the way it phases in over the years. And so 2015 continues to be what we'll call the carrot and the stick method. The carrot for the ACA is that premium assistance tax credit is available to help eligible individuals purchase health care insurance either through the exchange or other ways. And you qualify by this by individuals with household income between 100% and 400% of the federal poverty level. That's the qualifications. And in 2015, that's income between $23,000 and $94,000. So generally, individuals who are offered coverage through an employer health plan don't qualify for this credit, but those who don't have those coverages do have that credit. Now, that's the carrot. Now, the stick is what may affect a lot of taxpayers, because for 2015, if you're a U.S. citizen or legal resident, you generally will be required to have adequate health care coverage. If you don't, you face a penalty tax unless you qualify for an exemption. In 2015, the tax is equal to the greater of 2% of the amount of your household income that exceeds a specific amount, generally the standard deduction plus the personal exemption, or $325 per uninsured adult, and then the maximum of household is $975. So while you hear the word ACA, the Affordable Care Act, you also hear the terminology shared responsibility. And so the shared responsibility is this stick that everyone has to have health insurance. If they don't, they're going to get taxed on it. So the bottom line is most people will receive some different tax forms that come in, and you don't have to necessarily put those tax forms with your tax return. And if you have coverage, you may simply just have to check the box literally on your tax return that you've had health coverage for every month out of the year in 2015. However, if you didn't have coverage, either a part of 2015 or not during 2015, then you have to go through some computations to see how much really the penalty tax would be for not having that health insurance.
Okay, Doug, after completing my personal tax return, the result is either going to be that I owe taxes or that I get a refund. All right. So it's one or the other. I don't think there's any in between, is there? And how should I approach each of these situations?
Well, obviously, if you owe taxes, the answer is, unfortunately, you have to pay it. The issue might be, though, that if you're not able to pay it, you can request an installment agreement. So there are a lot of situations to where you're not able to pay the complete tax that are owed. So the IRS does allow an installment payment agreement. It's a monthly payment plan that you arrange with the IRS. the amount of the payment is based on how much you owe and of unpaid taxes and your ability to pay that amount. So there's you can go through a computation. To do that, you really just have to contact the IRS by mail or telephone and actually file a form. Where it gets a little bit tougher is that if you owe more than $50,000 in tax, then there's certainly, you still can get an installment plan, but it gets a little bit more expensive. So you really have to consider that. There's a charge for setting up this agreement, and interest is charged along the way.
May I interject here that it might be a little bit less expensive of paying those penalties and taxes to meet with a person like Doug, do a little proactive tax planning during the year so that you can avoid this problem and maybe pay some estimates or whatever is necessary.
Absolutely. And that's where you get into 2015 and being maybe frustrated in preparing the tax return and then seeing what the results are. A lot of people, what we call, complete it and forget it. In other words, this tax return's over. Let's forget about those financial situations until this time next year. But hopefully that's not the case, because now is just an opportune time as you go through the 2015 tax return to plan your 2016. And some of the things we've talked about, whether it's the health insurance plans, there's availability of health savings accounts potentially at where you work, flexible spending accounts that you may not be taking advantage of, and retirement plan contributions. Again, we mentioned it, but now that you have 11 months to prepare for your 2016 taxes, you may have the availability to put some money away before you get to this time next year.
Doug, I often ask people, did you pay your CPA a fee last year for any tax-forward planning other than his tax preparation services? That's a loaded question. Most people don't. But if you do sit down with a CPA and do what you just described, then you're going to get charged a little fee. But it certainly is going to be better than paying what you have to pay if you have the problems that we've discussed here in the last few minutes.
Absolutely. And kind of referring back to if maybe you can avoid having to owe as much or owe taxes at year end, where you're going to have to get a loan and installment and charge interest, but also it will help you in the future. It's a long-term outlook so that you're able to, and that's why I talk about financial leadership culture. You have to have a culture of planning and saving and doing things, and tax return is certainly a significant part of it, and that's the basis of how you start to plan things. But usually if you get a professional, well, we have to live and eat and pay for those twins that I was talking about for me. But it certainly is a beneficial payment because it's an investment in not having to pay as much taxes in the future.
735-5065 if you'd like to arrange a meeting to meet with Doug and talk about your tax concerns or have a question for him this morning. Doug, does that cover the tax liabilities and the discussion you wanted to have with that? Should we move on to refunds?
Well, yes, the refunds, absolutely. It's a lot of people just want the refund, send it back. But you really need to consider that, again, in this tax planning mode, that if there is a refund, you have the option of leaving it with the IRS and applying it to your 2016 tax liability. So, again, instead of getting that money back and spending it and maybe getting to this time next year and owing money, it helps you to, again, plan ahead and pay it forward, if you will, so that you won't owe as much tax in 2016.
So, Doug, we often promote doing tax-forward planning, enlisting the help of a CPA to do your tax returns. But what if you just have that basic return and it's really simple? Maybe you don't have access to a program like Quicken or something like that, or TurboTax that can help you do this instantly. Can people get help from anywhere else?
Absolutely, and I do recommend the IRS. You can go directly to the IRS, and you can. There are phone numbers that you can call, but a great resource, and it's getting better, literally by the month. That is IRS.gov. So if you write down anything today, instead of Googling something related to taxes, you want to make sure you write down IRS.gov, because if you go to that website, I'll give you just 10 quick things that you can do on that website that really help out, that, again, helps inform yourself but get things done without even having to go through a professional. The first one is just get answers to your tax questions. There's an interactive tax assistant online so that you go in and there's an IRS map, and it's very easy to use. It's user-friendly, so that you can go in and gives you a list of tax law subjects to review. It combines tax topics, forms, instructions that you don't need to know those things. You just go to that area, and all of a sudden it kind of guides you through. So, number one, you can get answers to your tax questions. The second thing, you can get the forms and publications on the IRS website. Used to, the old-fashioned way, you had to go to their location and pick up paper forms. That's no longer applicable. And you can file free depending on what you earn for the year. There are limitations that if you earn $62,000 or less, you can prepare an e-file and get that done free. We talked about the Affordable Care Act, and that's something, again, you go to the IRS.gov website. There's a lot of information there and easy to go through. And then once you've filed your taxes, you can check on your refund if you get a refund. If you owe, you can pay on that website. But you can also...
Aren't they automatically going to say checks in the mail?
That's right. We're a little bit past the checks in the mail at this point, and wanting to do some direct deposits. So unfortunately, that's coming about too. But you can also apply for IRS payment plans on the website that we talked about. That when you get an installment plan, you can do it through the website. And on charitable contributions, you're able to check out charities on that website. The IRS website has a whole section related to exempt organizations. And if you're really trying to check in, should I pay this charitable contribution to this charity? You really can go on the website to see if they're viable. And then you can calculate your tax withholdings back to the tax planning. If you got way too big of a refund, or you're going to owe way too much after you compute your tax returns, you might ought to sit down with your current salary and see what kind of tax withholding should I have for 2016. And then finally, if you've misplaced or need to get some of those old year tax returns, you can get a transcript you go to irs.gov to get a transcript, and you can get that. So the IRS website really has picked up several advantages over the last few years, and again, it is getting better.
Doug Schneider is with us this morning here on Retire Right. As we've learned today, Doug certainly understands the importance of preparing a personal tax return correctly, even though it can be confusing, frustrating, and sometimes costly when these little areas that we've talked about today can be overlooked. Certainly there's several money-saving deductions and credits that can be overlooked, and Doug, we thank you for sharing those today. Doug certainly is going to keep you informed if you'd like to work with Doug in the future and have him help you with your taxes. He keeps informed in the changes in the tax code, and that's why we asked him to be our guest here on Retire Right, our first guest of 2016. So you're top on the list to us, Doug.
Thank you, Rick. Yeah. I always enjoy being on the program.
Now, Doug, I know that there were several topics that we talked about today, tips in preparing your 2015 personal tax returns. We'd like to also encourage people, if you were writing notes as fast as you could today but missed a few things, that you request a transcript of today's show, and that information will certainly be emailed to you. You can send me an email at rick@cfpgroup.biz, and we'll get that out to you through Doug's help. Doug, anything else that we want to talk about upcoming here in February of this year?
Well, the deadline you think for your personal tax return is April 15th, but those people who have children who are in college and are looking for federal assistance or potentially tuition, it's quicker than that, because there's federal forms, the FAFSA as they call it, the federal forms that need to be filed that include the tax return. So you'll see a lot of these people pushing to get their tax return done, not because it's April 15th, because they need to get it submitted to the government or to the colleges for that. So actually the AICPA, the American Institute of Certified Public Accountants, has deemed February as Financial Aid Awareness Month, so that, again, we can inform people on the best way to go about trying to get some help paid for college.
Yeah, now, Doug, I'll put you on the spot with a quick one here. I hope you know what the answer is to it, but I think because of the flood last year, we had some extensions from extension dates, too, that are coming up here in February, aren't they?
That's exactly right. In other words, there are, depending on the areas you live in the country, and certainly most of South Carolina is covered, there are some extensions for almost all the forms that you're going to have to file for for the state and for the federal.
But that was for 2014 tax extensions?
There's also some in 2015, but we will have to look those up for the details.
All right. Call Doug, 735-5065, if you want to find out about the extensions. Thank you for listening with us this morning here on Retire Right. Doug Schneider, my guest. Certainly you can reach him at 735-5065. And join us again next Saturday morning for another half hour of Retire Right with Rick Durkee. Shane Griffin will be back as my host Saturday mornings, 9 a.m., 94.3 WSC and 94.3WSC.com.